Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner and Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what's in store on today's show. First up, we're going to be talking about the student loan market. And the question a lot of people are asking, is that going to be the next shoe to drop when it comes to consumer credit? So we'll talk about some of the figures in an interesting study that just came out, because that's obviously a topic that, as I've referred to on the show many times before, I'm very concerned about the student loan market and the cost of college in general. And then who better to talk to about borrowing than our mortgage pro, Steve Tetzner from Homestar Mortgage. We're not going to be talking about student loans, but of course we're going to be talking about home loans. And what do we have to look forward to in 2018? There's some interesting changes potentially in the markets and some things that are staying the same. So we want to go over that with Steve, and we're happy to have him here. And then in our third segment, something I find to be a fascinating story, and that is a bet that billionaire Warren Buffett made 10 years ago, and the bet just paid off in 2017. So we're going to tell you what the bet was and how he won it and what the stakes were, because it's kind of an interesting story, and I think it sums up a lot of what we need to think about as individual investors as we make decisions about our portfolio. And then finally, in the last segment, we're going to be giving some updates on 529 plans, some interesting developments for Massachusetts residents that may be listening to the show, and we want to update people on some things that will apply to Rhode Island residents as well. So we've got a lot to get to, so let's jump right into it. First up, I want to talk about college loans. So I want to put up some statistics about college loans that I think everybody should be aware of, because I think the fear here with this market is we all know that a big part of the financial crisis in 2007, 2008 was issues with home mortgages and defaults and trouble that the banking sector ran into. And so there is some question about what's the next segment of consumer debt that could potentially see a lot of defaults. And a lot of people are pointing to the student loan market as being a possible victim. So let's throw up this slide and we'll talk about some of these figures. First up, $1.4 trillion in outstanding debt. Now, we talked a couple of years ago about the fact that college loan debt exceeded credit card debt. So the next point that I'm going to put up is that number two here, student loan debt is the highest, largest piece of consumer debt outside of mortgages. So it's second only to mortgages in terms of the volume of outstanding debt. And then the third thing that's worth mentioning is it's the only sector of the consumer debt market that's actually grown since 2008. So most of the other sectors, credit card debt, and Steve may correct me on this, but according to my figures, mortgage debt, approximately the same total outstanding balances, but we see growing student loan debt. So it's a big outstanding debt for consumers. It's getting larger, and there are concerns that default rates are increasing. So Brookings Institution did a report. They're sort of a Washington think tank type organization, and they did a report that looked at student loans, default rates, and things like that. And I wanted to share some of the statistics because I do think it's a reason for concern. I don't think we necessarily need to sound the alarm bells, but it's certainly something as a consumer, as a student, as a borrower that we're going to want to pay attention to. So the first thing is 40% of students, according to their estimates, could be in default on student loans by as soon as 2023. And the biggest default rates, and we've talked about this before on the show, the biggest default rates for student loans are in for-profit institutions. So colleges that are not your typical nonprofits you would think about when you're thinking about a college education, but for-profit institutions, they often advertise on TV. Many of them are trade schools. That doesn't make them bad organizations, so I'm not here to lambaste them, but to point out that the default rates are much higher for students that attend those institutions. 43 out of 100 students who started in a for-profit institution in 2004 defaulted within 12 years. So in for-profit institutions, students have a 40% default rate since 2004. Only 11 out of 100 students since 2004 have defaulted on loans to nonprofit institutions, what I'll call more traditional colleges and universities. So things to consider as a consumer, I think the first one is you need to understand your repayment options. There's definitely a lot of statistics out there that indicate that borrowers, when they get out of school, they don't understand what their options are. There are income-based repayment options. There are options for consolidating and extending loan balances, loan payoff schedules, and things like that. So there are ways potentially to do that, but knowledge is key here. And the other thing is, as parents and students, you really have to think carefully about how much you're borrowing and ultimately what the return on that investment is going to be. Education is a great thing, but spending on it at all costs and borrowing stratospheric sums of money really has to be balanced against what the income potential is in the end, or you risk being one of those statistics of people that default. And that's something that you can't get rid of in bankruptcy, so it's something that's going to stick with you for a very, very long time. All right, up next, we're going to be joined by Steve Tetzner with Homestar Mortgage. We're going to be talking about what's in store for us in 2018 in the mortgage market. Stay with us, there's more to come. Welcome back to the Money Pros. We're joined now by our Mortgage Money Pro, Steve Tetzner with Homestar Mortgage. Steve, thanks for being with us. Happy New Year.
Happy New Year.
First visit of 2018.
Excited to be here.
That's exactly what we're talking about, right? 2018. Yep. So before we jump into the look ahead portion of our segment, let's take a look back. 2017 was an interesting year across the board, whether it was politics, business, just a whole slew of different things. But if we talk about mortgages and real estate, I'm curious to get your perspective on what you thought of 2017.
I thought it was a good year for real estate. We saw, if you've seen any of the statistics here in Rhode Island, consistent increase in values across the entire state, really driven by a lack of inventory. A lot of buyers out there, not enough properties to buy. Rates have held very steady. Your 30-year mortgage rates are still under 4%. We've consistently seen prime go up, so we know that the economy is starting to grow. And I think that going forward to 2018, we're going to see even a little bit better year than we did in 17.
Now, I think, and as we're taping this, the stock market is booming. It's funny, in my experience in dealing with clients in the stock market, when things are going down, they're worried. When things are going up really fast, they're worried then too, so why not? Do you see any of the frenzy that maybe would have been reminiscent of 2006, early 2007 in the real estate market, or does it seem a little more reasoned right now? What's your, and obviously that's just a personal opinion, but I'm curious to see what you think.
I think that's a good question. You have to remember that back in 2005 and 2006, the real estate market was driven by mortgage programs that people really didn't need to qualify to be able to buy the house. There were no income verification, no money down with no consequences, bad credit. I mean, anybody, if you could blow on a mirror and fog the mirror up, you could get a mortgage. We don't have that right now. I mean, all the lending programs are very solid. Everything is income-based. You're seeing people that really qualify for houses. I'm seeing a lot of people very responsible that are saying, geez, I qualify for a $2,500 a month mortgage payment, but I only want to spend $1,800. So no, I think that this is driven by the economy. It's driven by demand. I don't think that it's the same market as 2006 at all.
So take it and maybe enjoy it a little bit and relax. That'll be part of the message. So let's talk about going forward, because there's some stuff going on in 2018. So this is a great time to talk about it. And you sent me, some information. I was reading through it, and I'm like, I'm curious to hear more about this. And one of the first things you mentioned is Fannie Mae and Freddie Mac easing debt-to-income ratios going forward. So before we talk about the easing of the debt-to-income ratios, just remind everybody who Fannie Mae and Freddie Mac are. They're not your aunt and uncle. There's somebody else, right?
Yes.
Okay.
So Fannie and Freddie, I mean, if you go out and get a mortgage, whether you're going to a local credit union or a bank or a mortgage lender, basically the money's coming from Fannie and Freddie. Fannie and Freddie are selling the mortgage-backed securities in the secondary market. They're raising the money, and that's essentially where your mortgage money is coming from. That's who your actual contract is.
So they have a lot to say about who's gonna get the money in a loan.
They set the guidelines. So if you don't adhere to their guidelines, you can't sell the loan to them after the closing.
And it's some of these guidelines that are changing. So why don't we talk about that?
Yeah, well, it's interesting you brought up the student loan, because recently they had a change to their guideline with student loans. They used to not allow a borrower to qualify for a mortgage based on the income-based repayment plan. That was a change they made a few years ago. So if a borrower was on an income-based repayment plan or an interest-only plan, then they had to qualify based on 1% of the principal balance of the loan.
Interesting. I had no idea.
Yep.
Okay.
So now they've changed that, and they said, look, we're going to go by whatever the payment is that's on the credit report. So if someone's on an income-based repayment plan, they can use that payment in qualifying in their debt-to-income ratios, which has actually been a very positive. You know, when you have a lot of people that have really high student loan debt, like physicians or attorneys that are on the income-based plans, and now they can afford to buy a house. And you know, their income is going to go up. They're not defaulting on the student loans, and they're paying as agreed. So why should they be penalized?
This makes a ton of sense, because an income-based repayment plan is a great way to make a student loan affordable. And the whole reason you want to make it affordable is so people can live their lives and do other things, like borrow money to buy a house.
Yep.
And potentially that was jeopardized by these rules, which have now changed.
Correct.
Okay.
Yep. So that's been a big change to the positive. But they've also changed. What was happening is Fannie and Freddie were when you were trying to get the loans approved through their automated underwriting systems, they had a pretty strict 45% debt-to-income ratio. Unless you had some significant compensating factors, which means that, you know, really big down payments, strong reserves, really high credit rating, they might go up and fluctuate a little bit on that, and there was a little bit of play. What they've done is they've eased those qualifications now. So we've seen that pendulum swing all the way to the right, where things got really, really strict, and it's just starting to ease back a little bit now. Now, I'm not talking about risky borrowing. I'm not talking about not verifying people's ability to repay the loan, but they're giving people a little bit more latitude to make decisions, and their own financial decisions, rather than being tied directly to a very strict formula.
Make it a little more attainable for people that want to buy a house. Does that mean that somebody that was maybe couldn't buy a house last year, or maybe they looked into refinance, maybe that's not a good example, but somebody who's going to buy a house and they were turned down because there was an issue with debt-to-income ratio, is that something where now, even if nothing's changed with them, maybe they should revisit it with their lender?
Yeah, absolutely.
Okay.
You know, when you're talking about being able to extend, let's say, 3% in a debt-to-income qualifying ratio, and somebody makes $60,000 a year, and that's $5,000 a month. So you take 3%, that's another $150 a month now that they can put towards their housing payment. You know, $150,000, that's going to increase their buying power by $25,000, $30,000 on what they qualified for before.
Could make a real difference in neighborhoods, towns, things like that.
Yep. And this is not a situation where, you know, you're having a borrower that is qualifying with a payment that is based on, you know, where we're saying, oh, well, we're just going to let you spend what you can't afford. A lot of times there are situations with people like they started a new job and they've only been there for a year, so they're making overtime and bonus income. We can't necessarily use that in the qualifying ratios, but that income is there, you know. Or they have a spouse that they're not putting on the loan that, for one reason or another, that there is additional income. So it's not risky lending.
Very reassuring, but encouraging for people that may not have been able to get a loan, that this may change things for them or allow them to get a more desirable place potentially. Another thing we've talked a lot about on the show is PMI, and so let's talk about just quickly what that is, but potentially rates for some borrowers are going to go down. Let's talk about that.
Yeah, recently the mortgage insurance companies have submitted, and they've come out with some new rate plans for the mortgage insurance. And PMI is not like homeowners insurance. It isn't based on, okay, the house is worth $300,000, so to rebuild it, you know, your insurance is $1,200 a year. PMI is based on a factor. It's based on a percentage. So it's based on.
And this is to reimburse a lender if you default on a loan,
correct.
Is it not? Okay.
Correct. It's insurance to reimburse Fannie or Freddie to share the risk on the loan in the event of a foreclosure. So the PMI factors are based on credit score. They're based on loan to value. Which is the amount of down payment that you're making, and they're based on a factor that ties into the size of the loan. What we've seen is that in the higher FICO scores, the lower risk borrowers, the PMI companies have gotten very, very aggressive with lowering their PMI factors.
So high FICO scores are people with very good credit scores.
Very good credit ratings, and they're being rewarded with very low mortgage insurance premiums, which is, again, allowing people to spend more and making housing more affordable.
So just another example of why good credit, or really good credit, can really save you a lot of money. We've always known about the interest rates. It also impacts the PMI. Some other interesting news, and I saw this on your Facebook page, by the way. You can all follow Homestar Mortgage on Facebook. Tax credit programs, and I believe this is local to Rhode Islanders, is it not?
Well, it's the way that the tax credit program in Rhode Island is done is fairly unique. It's a program where a first-time home buyer who qualifies under a certain income limit can receive a rebate of up to 20% of the interest that they pay on their mortgage in the course of the year. So if somebody is paying, $10,000 in interest,
a lot of money.
They're going to get $2,000 back.
Yeah.
The other $8,000 they can then put as a tax deduction, but this is a dollar for dollar 20% rebate. That's significant. That also helps first-time home buyers. We can use that extra income that they're going to get back, the rebate, to help them to qualify to buy the house as well.
Do these programs go away and they're coming back, or
well,
is this
what
a
happened
renewal?
Was the program existed, and then in December it was suspended because one of the proposals with the new tax plan was that the funding for these plans was going to be revoked. So we were unsure. So the plans all had to be suspended. When the new tax plan came out, the money was, in fact, in the tax plan. So they've all come back now.
So about 30 seconds left, and the last thing we want to talk about is tax changes. But not a lot of changes to mortgage interest deductions, so that's going to be a good thing for 2018.
Yeah,
right?
I don't think it's going to affect the average consumer. I think that it might affect some people on the high end, people with expensive second homes with mortgage interest on the second homes changing a little. But other than that, the average consumer buying a house,
$750,000 of mortgage debt, that's going to cover, I imagine, the vast majority of the people that you're dealing with, right?
So I think that the minor changes that were tweaked are not going to have a negative impact on the housing market at all.
So a lot to look forward to in 2018, but it sounds like all positive changes, and the first thing you said, which I take a lot of comfort from, is doesn't seem like the frenzy maybe of 2006, a little more reasoned and not the crazy lending that we used to see, right?
Correct.
All right. Steve, great to have you as always. Thanks for
pleasure.
joining us. All right, we'll see you again soon.
Thank you.
All right, up next on the Money Pros, the Warren Buffett bet and how it paid off for him big time. Stay tuned, there's more to come. Welcome back to the Money Pros. Now we want to talk about a major bet that billionaire investor Warren Buffett made back in 2007 and how well it paid off for him 10 years later in 2017. Warren Buffett, as most of you know, and most people know him by, is the world's greatest investor. He's chairman of Berkshire Hathaway, which is a conglomerate that owns companies from Geico Insurance to the Dairy Queen. And Warren Buffett has consistently, over the past couple of decades, been among the top 5 richest men in the world, a title he's anxiously trying to shed by donating much of his wealth to charities, which is an impressive effort. But what we want to talk about is a bet he made in 2007. He made a bet with a hedge fund manager at Protégé Partners. Now, Protégé Partners specializes in managing investments in hedge funds. So they select other hedge funds, they put together hedge funds portfolios. And the bet that Warren Buffett made was, because Warren Buffett is no fan of hedge funds, that an S&P 500 index fund that Warren Buffett would choose would outperform the basket of hedge funds over a 10-year period. So they bet back in 2007. What was the bet? Each participant, Protégé Partners and Warren Buffett, each put up $320,000 that they put into their respective investments. The $320,000 turned into $2.2 million 10 years later. Here is the key takeaway to the story. And folks, if you manage your own investments or you pay somebody to help you with it, this is something you want to pay attention to. Buffett won the bet. The S&P 500 index fund that Buffett chose far outperformed the basket of hedge funds that everybody thinks that's what the smart money does. You got to invest in hedge funds. You're a fool if you invest in mutual funds, or you do any of these kind of consumer retail investments. But it wasn't just by a little bit, it was by a lot. The S&P 500 index fund over a 10-year period starting in 2007 returned 7.1% per year. And I don't need to point out, but I will anyway, that 2007 means that this investment was made before the financial crisis. So that return includes the collapse in financial markets that occurred in 2008 through 2009. How did the hedge fund do? Over that same 10-year period, the hedge fund investment was only up 2.1% per year. So a difference from 7.1 to 2.1, an entire 5 percentage points a year. And if you don't think that that's a lot of money, consider this. If you were to invest $100,000 back in 2007, maybe it was your retirement fund, IRA, whatever portfolio it was, and you invested it in the S&P 500 at 7.1% per year, your investment after 10 years would be worth $198,561. At 7.1%, you would have nearly doubled your money in 10 years. What if you'd been the smart guy that put all your money in those hedge fund investments because everybody told you that that's where the smart money went? Well, at 2.1%, that $100,000 investment would have only grown to $123,100, a difference of approximately $75,000. Warren Buffett made this bet because he didn't think much of hedge fund performance, and what he really didn't like were hedge fund expenses, which can be really, really expensive. So next time you think about what the smart money is doing, consider that it's not always rocket science to invest your money wisely, and the best investor in the world put his money on an S&P 500 index fund. It's a great lesson for everybody, whether you're investing $1 or $1 billion. Keep that thing in mind. All right, up next, we're going to be talking about some changes to 529 plans. Stay with us, there's more to come. Welcome back to the Money Pros. I want to take the last segment of the show to update you on some changes to 529 plans that have come along somewhat due to the tax law changes, but also just some individual state changes. So let's throw up a slide and we'll go through them really quick with the last minute we have. First up, in Rhode Island, you've always been able to deduct either $500 if you are a single filer or $1,000 if you're a joint filer of 529 plan contributions. So if you're married, you put in $1,000 to a kid's 529 plan, you can deduct that on your Rhode Island return. And that's been a nice feature for Rhode Island residents that Massachusetts residents did not share. Well, that is changing for 2018. So effective in 2018, bullet point number 2 here is that in Massachusetts, they've actually one-upped us. Now, if you're an individual filer in Massachusetts and you contribute to the Massachusetts 529 plan, individual filers can deduct up to $1,000 of contribution, and if you're married, you can deduct up to, or married filing jointly, you can deduct up to $2,000. So whereas previous to 2018, people could not deduct contributions in Massachusetts, you can now. And the last thing I want to put up there to keep in mind is that now, thanks to the tax law changes, you can now use funds from a 529 plan to pay for pre-college expenses. Up to $10,000 can be used for elementary and secondary education. That includes private schools, parochial schools, and things like that. So I expect 529 plans to become a lot more popular, particularly in Massachusetts. Thanks for watching the Money Pros, folks. Great to see you as always. We'll see you again next Sunday. Take care.